For years, we've worried about recessions. We've feared market crashes. But what if the next great economic threat isn't a sudden storm, but a slow, suffocating chokehold? What if it's a danger so insidious, it leaves no place to hide for your investments? I've just finished reading one of the most eye-opening analyses I've seen in a while. A deep dive into stagflation by MSCI, built using their macro risk model. And let me tell you, if you're not paying attention to stagflation, you might already be too late. This isn't clickbait. This is the downside scenario that could rewrite your entire investment playbook. Stick around. We're going to unpack what stagflation really means, asset by asset, currency by currency, and why it may be even more damaging than a recession. Don't just watch from the sidelines. Understanding this threat isn't optional. It's survival. Chapter 1. The Rising Tide of Stagflation. The anatomy of a silent threat. To truly grasp what's coming, we need to dissect the anatomy of this beast. Stagflation, a word that sounds like financial folklore, is very real and very dangerous. We pulled insights straight from MSCI's July 2025 research, and here's what they modeled. Stagflation is defined as the toxic mix of stagnant growth and spiking inflation. What brings it back into focus? Geopolitical tensions, notably the Iran-Israel conflict, spark fears of oil spikes. In MSCI's scenario, they model a persistent 20% increase in oil prices. Add to that, widening U.S. fiscal deficits from new tax and spend policies, delayed tariffs, supply chain friction. Even the OECD is raising red flags, lowering U.S. growth forecasts, while increasing inflation expectations. This isn't theoretical. It's a blueprint of what could go wrong, and fast. But theory becomes real when it hits your portfolio. And this is where the numbers start to bite. Chapter 2. The Portfolio Under Siege. Where will you hide? This is where the nightmare begins. We looked at MSCI's stress test of a typical multi-asset portfolio. 50% global equities, 10% treasuries, 10% tips, 10% investment-grade bonds, 10% high yield, and 10% U.S. real estate. In their stagflation scenario, this diversified mix could lose 12%. Let that sink in. 12%. With bonds, private equity, and real estate all in the red. U.S. equities, down 20%. Treasuries, down 6%. Tips, even inflation-protected bonds take a hit, down 3%. The diversification we count on breaks down. MSCI's phrase was chilling. No place to hide. But to understand why this scenario is more dangerous than a recession, we need to zoom out. Chapter 3. The Scenarios Unveiled. A comparative threat assessment. MSCI didn't stop with stagflation. They also ran simulations for a recession scenario and a stable growth outlook. Here's the comparison. Under recession, the same portfolio loses 9%. Not great, but bond prices actually rise as yields fall, cushioning the blow. In a stable scenario, the portfolio gains 3%, driven by a 5% bump in U.S. equities. But stagflation? The 12% loss is worse than a recession. Why? Because bond yields don't drop. They rise, which means even your safe assets hurt you. In a recession, bonds protect you. In stagflation, they betray you. And yet, there's a twist to this horror story, because the severity of the hit might depend on something most investors overlook: your currency. Chapter 4. Navigating the Storm. The Currency Dimension. Here's where it gets unexpected. According to MSCI, the currency you measure returns and changes the outcome dramatically. In US dollar terms, almost every asset class bleeds, but in Japanese yen or Swiss francs, that same global equity loss drops from -15% to -5%. US treasuries go from -6% in USD to +4% in yen. Even global real estate shows a gain in yen. Why? Because in global stress, the yen and Swiss franc often strengthen, acting as a shock absorber. MSCI's analysis reveals a critical truth. Currency isn't just a side note, it's a line of defense. So what do we do with all this? Where do we go from here? Let's recap. Stagflation is no longer just a ghost story. It's a downside scenario with real triggers: war, debt, supply chains, and real consequences. MSCI's research shows it's worse than a recession for your portfolio because bonds lose their magic. Equities, real estate, even private assets falter, and traditional diversification doesn't hold. If you're not factoring stagflation into your thinking, you're flying blind. So here's the ask. Share this video with anyone who thinks a 60/40th portfolio still works in all weathers. Like this video to help more investors get critical insights. Subscribe for more sharp, no-fluff financial intelligence, because we cut through the noise and bring you what actually matters. We've read the models, connected the dots, and delivered the message. Now it's your move.